Good morning, all. Thank you very much for joining us today. My name is Meera Rajah. I head up James Cooper Creston's Indirect Tax Services. I'm here today with my colleague, Toby Thorne. Our aim is to cover and update changes in a variety of areas since Brexit. We will be covering sale of goods from UK to EU and vice versa, moving goods to Northern Ireland and the trade support services, country of origin rules, and also we will be covering some other updates, recent updates, and impact of the reverse charge for building services and making tax digital updates. Right, if I'm going to start, I'll start first of all with the impact of Brexit on the movement of goods. Pre-Brexit summary, just briefly, I just want to mention the goods physically moved from the UK to the EU. In 2020, the sale was zero-rated intra-EU dispatch. But post-Brexit, last year, the goods moved with the modest number of documents, a community transit document, but now a full export entry is required at the UK border, and a full import entry into the EU. Now in 2021, the sale is a zero-rate export, increased requirement for UK exporter to obtain and keep evidence of the removal of the goods to the place outside the UK, shipping documentation, airway bills, etc. One of the good things of post-Brexit is, less admin burden on EC sales list. There's no need to do that anymore to HMRC, no need for report of EC sales list. If UK seller had not previously exported goods or imported goods from outside the EU, they need a UK EORI number. I will go a bit more into it later. The Intrastat supplementary declaration also no longer needed. You don't need to do that anymore. In UK import, VAT will be due either at the point of importation or as part of postponed VAT accounting method. Right, in EU, purchaser will be required an account for import VAT. Most EU countries have postponed accounting, but some do not have these, including countries like Italy, Cyprus, and Germany. And potentially customs duty if the goods do not originate in the UK, this will apply. So for an example, if a UK company imports goods from China for resale and exports to the EU, the country of origin is China. And depending upon the tariff commodity code in the EU, tariff will be subject to customs duty. By default, a product that has 60% of its sale value added in the UK becomes UK origin. Again, I will go into this a bit more in detail later on. Goods subject to selective physical customs checks at the border. There are particular issues for road transport that crosses more than one EU member state border, need for the whole year to have a UK customs comprehensive guarantee to cover the potential import VAT and duty in the EU. The full export entry will need the tariff commodity code, which is found in the next UK tariff. The actual codes are the same as EU tariff, but if the UK businesses seek and obtains a binding tariff ruling from HMRC, this will apply only to the UK and EU and the EU may have different interpretation. So this is basically, they've not changed the tariffs at the moment. What they've done is they've just taken the same as what is been in the past as the EU tariff. The next bit I want to talk about is a Brexit triangulation. So triangulation in the past involved 2 suppliers of goods between 3 value-added tax registered traders in 3 different European Union member states. This was pre-Brexit. Now, post-Brexit, what's happening is, following the UK leaving the EU, the VAT regime from 31st of December 2020, UK suppliers have lost the right to use business-to-business, B2B, VAT triangulation simplification when selling goods between EU member states. UK businesses will no longer be able to invoice VAT free using their Great Britain VAT numbers when their supplier and their customer for goods are in different EU member states. EU suppliers will lose out too, as UK legs triangulation supplies will incur import VAT following Brexit. This is because we are not part of the EU again. Our goods will be treated as import and export rather than going into this triangulation. The impact will be the need to replan the contracting supply chain, manage import VAT, or consider if extra VAT registration would resolve the problem. Northern Ireland goods transactions stay within the triangulation rules. So for Northern Ireland remains within the EU VAT regime for certain goods transaction. So a Northern Irish VAT number may still be used for triangulation where there is a Northern Ireland element. So the next bit is, I want to talk a bit more about animals, plant, and increased cost and time of VAT checks and certificates. As part of the phased approach to introduction of import procedures, there will be controlled imports of animal products, including fishery products and plants. The movement of animals and plants now incur increased cost and time of VAT checks and certification. Last year, the goods moved within a modest number of documentation, as I mentioned before. A community transit document, but now a full export entry is required at the UK border and a full import entry into the EU in addition. The basic entry, other documents for import and export referred to earlier. So these are like safety and security declaration, certificate to improve origin of goods, health certificates for live animals, and food. The next bit I want to update you all on is sales of general business to customer position where we are at. Sales of goods following end of distance selling, VAT registration in member states. So prior to Brexit, VAT on the B2C sale of goods could be accounted for in the UK until threshold value in the EU member states of destination was exceeded. In 2021, there are limited available options as follows. So you have one option which is register in customer's EU member states, pass responsibility to consumer, or arrange for courier to declare and pay import VAT and duty on your behalf. But from 1st of July 2021, the good news is that they're introducing EU one-stop shop. So these new rules are part of EU new e-commerce package and will look to introduce a VAT one-stop shop for B2C sales. Originally, due to come to force from the 1st of January 2021, the main aim of this package is to simplify VAT obligations for companies carrying out cross-border sales of goods and services, mainly online, to consumers. This will ensure that VAT is paid correctly to the member state in which the supply takes place. So this will kind of avoid that you don't have to register in every single country if you reach the VAT threshold. So the current rules is under the current EU rules, the businesses from outside the EU are typically required to register in each of the various member states to which they will supply goods or services to report and pay EU VAT at various rates in their member states. Businesses offering B2C digital services can already use the mini one-stop shop, also known as MOS, to declare the VAT due on their supplies in a single quarterly VAT return by only registering in one EU member state. However, no such system is available to those selling physical goods, which means that imported goods from non-EU countries with value about 22 euros or £15,000 must register for VAT in each EU member state and make necessary declaration. The new rules from the 1st of July 2021 is the EU will create a similar one-stop shop for business to customer consumer supplies of all services and goods. So this is a big change to mini one-stop shop. So which will remove the requirement for businesses to have multiple VAT registrations and reporting obligations in the EU. At the same time, the decent sales threshold will be abolished and replaced with a common threshold of 10,000 euros or £8,600 throughout the EU, up to which business to B2C EU cross-border supplies remain subject to the VAT rules of the member states of dispatch, and above which supplies become subject to the VAT rules of the member state of destination. Under this new system, a single report scheme covering sales of imported goods to EU consumers up to a value of €150 or £135, and for which a VAT exemption upon import will apply if the trader declares and pays the VAT at the time of the sale using import one-stop shop. The new package of legislation from the EU will also open possibility of paying import VAT on customs declaration via simplified monthly payment. There are a few things to look out for. Any further details, please post your questions or ask us later, then we'll be able to go into it in more detail. There are general courier issues since Brexit, the lack of willingness of couriers to take more difficult shipments. Other challenges include delays and issues regarding extra unexpected paperwork. So these have been the most general issues around the movements of goods. I'm going to move to now moving goods from Great Britain mainland to Northern Ireland. Under the Northern Ireland Protocol, there have been some changes for goods movements into Northern Ireland from Great Britain. The UK has left the EU's customs union, and Northern Ireland will remain a part of the UK's customs territory. As a result, you will need to make declaration and pay any tariff due when bringing goods into Northern Ireland from Great Britain or from countries outside of the EU and the UK. There are several options available to make sure the right tariff outcome is applied on the goods you bring into Northern Ireland. Before moving your goods, you should consider which of these options is most suitable for your business. The government has set up trade support services with, it's also known as TSS with HMRC, as a free facilitation service for Great Britain, Northern Ireland goods movements. The process will be fully digital and fully facilitated by the TSS, and end-to-end service at no cost at all, businesses that can use. This free-to-use trade support services is available to business of any size moving goods into Northern Ireland, providing guidance, training, digital declaration, support services, and support from customs experts. So please do use this, because it's much better to use it and get their advice and training rather than trying to put something right once things have gone wrong. So this is this trade support services, we've been told, is pretty good, and then please make use of it. Right, the next one is I just want to explain a bit about country of origin rules. So our discussion point here relates to where goods meet the rules of origin requirements and tariff issues. Put simply, rules of origin are how customs authorities classify where an export has come from international trade. So there is preferential rules of origin and non-preferential rules of origin. Preferential rules of origin is if the UK and EU agree under a free trade agreement to remove tariff for each other's goods. This grants a preference not provided to others. So UK goods seeking to enter the EU under this preference will have to prove that they are from the UK under rules agreed in a FTA. This prevents a country without trade deal from accessing the EU market through the UK and vice versa. And the non-preferential rules of origin is outside a customs union. All UK exporters will still have to declare the origin of their goods when trading within the EU. This is used by importing countries to protect their producers and other monitoring purposes. So rules of origin refers to economic nationality of goods being imported and exported. For an example, where they have been produced or manufactured and not just where they have been shipped or bought from. Under the agreement, goods must be locally sourced or for having sufficient work carried out on them in the UK. So from 1st of January 2021, for businesses to benefit from preferential tariffs when importing into the UK or EU, they will need to claim preference on their customs declaration and declare they hold proof that goods meet the rules of origin. The UK and EU have agreed 12-month grace period. This means that until 31st of December 2021, businesses do not need suppliers declaration from business suppliers in place where the goods are exported, but they must be confident that the goods do meet the preferential rules of origin. Businesses may be asked to provide a supplier's declaration after this date. Right, I'm going to now briefly say a bit about UK businesses selling goods to EU business-to-business tariffs. The nil rate of customs duty on arrival in the UK only applies to goods which are primarily of UK origin. By default, the goods must have 60% UK value and be accompanied by a significant process in the UK, termed the country of origin rules. For an example, if a UK business imports trainers manufactured from China into the UK for onward sale to an EU retailer, the goods will attract UK customs duty on arrival in the UK and EU customs duty on arrival into the EU. The EU has free trade deals with other countries, so goods arriving from developing countries often do not attract customs duty. The country of origin rules are particularly important for UK businesses who import parts or components for manufacture or process into a final product, which are subsequently sold to the EU. UK businesses now importing goods from EU, B2B tariffs. From 1st of January 2021, the UK global tariff applies to all goods imported into the UK, unless an exemption, such as a trade agreement, applies. The EU and the UK have established a free trade zero tariff quotas where the goods meet the relevant rules origin. It should be noted that businesses in the EU will need to make customs declaration when moving goods between UL and EU, and they will need to check their country's customs procedures for moving goods. There are possible simplifications. For an example, if a UK seller has a trading entity, say inside the EU, divert sales to EU consumers to the subsidiary or parent company, the goods can be initially sold from the UK entity to their associated EU entity, a zero rate export of B2B goods. The importer will have to pay import VAT, but this will be recoverable via their VAT return. The free ports, I just want to quickly mention the free ports. The free port is a great introduction in the sense that you can leave the goods without paying, clearing the goods by paying VAT or duty. But one of the things which has come up very recently, the last week or so, what we have found out is the companies who export goods to 23 countries from UK free ports will have to pay full rate of customs duty in overseas country of arrival. So this only came to light about, I think, about 10 days ago. This is because these free trade agreements recently signed by the UK have a clause that specifically removes the reduced or nil rate of duty in the importing country if the UK exporter has already taken the advantage of the tax benefit of the UK free port. So that's something for you to think about when you are using the free port. Now I want to say about this postponed accounting for import VAT, which I mentioned earlier. So accounting for import VAT on your VAT return means you will declare and recover import VAT on the same VAT return, rather than having to pay it upfront and recover it later. So this is really great for cash flow purposes. So you will need to get your monthly postponed import VAT statement to do this. You must inform all freight forwarders you wish to operate postponed accounting. No application required, available to all UK VAT registered businesses. Applies to all importers into the UK and from EU and non-EU this is. So it's not just the goods arriving from the EU, it also applies to non-EU countries. So import VAT deferment accounts are no longer required. I know that we've talked a lot. It may be quite a lot to take in, but anything you need more information on or more detail on, please do get in touch with us or post the questions. Thing I have said in one of the webinars before, fortunately, myself and my team, we all like doing VAT and customs duty, so you don't have to. So please get in touch with us if you have any follow-up questions on any of those topics that we've just discussed. I'm going to hand you over to my colleague Toby Thorne. Now he'll talk about the domestic reverse charge for building services and making tax digital.
Thanks, Meera. Good morning, everyone. Yeah, as Meera just touched on, I'm going to be covering a couple of other changes that have been introduced for VAT in 2021. So firstly, the introduction of the domestic reverse charge for building and construction services, which came into force on the 1st of March 2021. This is effectively an extension of the Construction Industry Scheme, or CIS, and applies only to transactions that are reported under CIS and are between VAT registered contractors and subcontractors. So the scheme means that those supplying construction services to a VAT registered customer no longer have to account for the VAT element unless the customer is the end user. But we'll touch on that in a bit more detail later. So instead, the customer or the contractor up the chain accounts for the VAT, meaning that the services that the subcontractors are providing require the contractor employing them to handle the VAT and pay the VAT directly to HMRC. So this applies to both standard rate and reduced rate VAT supplies, but it doesn't apply to zero rated supplies. So I'll just rattle through some of the conditions of when the reverse charge applies. So there is a supply for VAT of construction services and materials. The supply is made at the standard rate or reduced rate of VAT. The supply is made between a UK VAT registered supplier and a UK VAT registered customer. Both supplier and customer are registered for the CIS. The customer intends to make an ongoing supply of construction services to another party. So that's sort of the key bit about that. That the customer is not the end user, for the reverse charge to apply, they need to be making onward supplies of construction services. The supplier and the customer are not connected, and the supplier is not an employment business. So when will the reverse charge not apply? So supplies of VAT exempt building and construction services, supplies that are not covered by the CIS, supplies of staff or workers, and supplies of materials only. So the reverse charge will not apply in any of those circumstances. Also, if the customer is not VAT registered, if they're an end user, or if they're an intermediary. So the aim of this is to reduce VAT fraud in the construction sector. So sort of like businesses in the chain sort of going missing and not declaring their VAT. So just removes that process of having to sort of pay and declare the VAT to HMRC. It will require some sort of significant changes in the approach of many of these CIS businesses. So staff will need to be trained to identify relevant CIS contracts and end users. Accounting and bookkeeping systems will need to be modified to cope with the sort of new invoicing and reporting. And then cash flow, especially for those sort of at the start of the supply chain, where they're not going to be getting paid this 20% VAT. So they might need to consider going on to monthly VAT returns to improve that cash flow position. And then, yeah, as the slide said, we just sort of put this flow chart up there as sort of a bit of a decision tree. Is a good way of making sure you get to the right end result. So yeah, are the supplies within the scope of CIS? Is it standard or reduced rated? Is your customer VAT registered? Will your payment be under the CIS? And then are they end user or not? And then, so the other changes that have come in 2021 are to do with making tax digital. So from the 1st of April 2021, sort of UK VAT registered businesses will face more MTD obligations. Previously, they were going to be introduced last year, but were postponed 12 months due to the pandemic. So, and these will also then be accompanied by the threat of penalties for non-compliance now, sort of all being introduced from the 1st of April 2021. So who's affected? There have been no changes to who is required to sign up for MTD. So it remains that all VAT registered businesses, individuals, charities with a taxable turnover above the VAT registration threshold are required to follow the MTD rules. Entities trading below the VAT threshold can join the MTD service on a voluntary basis if they wish. However, it was announced at the latest budget that from April 2022, all VAT registered businesses will need to sign up for MTD and submit VAT returns using compatible software. So if you're a VAT registered business that is currently not required to comply with MTD, you have sort of less than a year now until you will be required to do so. So the new rules, so essentially it's the end of the MTD soft landing period, which has meant that the first thing is digital records. So under these new MTD rules, businesses must keep and maintain VAT records digitally in a compatible software package that allows you to keep digital records and submit your VAT returns, or use bridging software to connect non-compatible software to HMRC systems. So this digital record keeping requirement is compulsory for all VAT periods starting on or after the 1st of April 2021. So records included under this requirement include sales and purchase invoices with VAT, but records not specific to the VAT return are not included. The other thing is digital links. So if you have more than one software package, and these need to be linked digitally. So this can involve sort of using formulas between cells in spreadsheets, emailing records, putting records on a portable device to give to an agent, importing and exporting sort of Excel and CSV files, or downloading and uploading files. So all of those are digital links. So we're getting lots of queries about whether sort of Excel spreadsheets and bridging software is still allowed. And they're still compatible. It's just that you need to make sure that there's those digital links. So you're exporting, you're uploading, or you're using formulas between cells and spreadsheets. And if you do all of that, then that's still compliant. You can still sort of continue using those cheaper methods indefinitely as it stands. So the key things to look out for is that you can't cut and paste manual adjustments and just manually adjust any of those figures once you have exported those workings to Excel. So sort of in practice, HMRC have recognised that there are certain sort of circumstances during the preparation of a VAT return when calculations have to be made outside of the software, and there is sometimes a need to enter data into the software. So there's no change to that. It continues to allow the use of manual calculations for special VAT schemes, such as sort of partial exemption and capital goods scheme. So the digital links between the software packages need to be in place before the business's first full VAT period after the 1st of April, so sort of starting on or after the 1st of April 2021. So unless you're on monthly returns, you've still got a little bit of time to make sure these digital links are in place. HMRC has offered an extension to the 1st of April 2021 deadline if there is no solution to IT issues and the operation of sort of this uninterrupted digital journey. So anyone wanting an extension must apply to HMRC as soon as possible and provide sort of the following information, sort of like an IT map, reasons why the business is unable to meet the 1st of April deadline, an action plan, sort of IT confirmation and timetable, and details of controls to ensure that any manual data transfer will be performed without errors. Sort of basically, they've said that a cost alone is not sort of an acceptable reason. So just because you can't afford a software solution isn't a valid excuse. And then the next thing, just so penalties, as I mentioned earlier, so sort of penalties have been introduced now as well. So again, from the 1st of April, HMRC is introducing a new penalty system for failing to meet these MTD obligations. So these sort of penalties or surcharges will apply to the first completed VAT return on or after this date. So they will be applied as follows. So a default is recorded for a failure to observe the MTD rules or missing a filing. In this case, a surcharge period lasting 12 months applies. If there is another failure, a surcharge sort of percentage applies to the VAT due on that latest VAT return. If there are then additional failures within 12 months, a point system applies. The points result in percentage surcharges, so starting at 2% and increasing all the way up to 15% for each accumulated failure. There will also be fines and interest charges if there are errors in the VAT return. Fines may be sort of up to 100% of the VAT due or overclaimed if the returns include careless or deliberate inaccuracies. And then finally, it sort of is loosely sort of linked to MTD. So before MTD was introduced, you could file through certain softwares using like XML, which was almost sort of like the way to submit a VAT return through things like Xero, Sage or QuickBooks prior to the MTD channel being opened. And these XML submissions have sort of become obsolete. So if you are a VAT registered business that is not signed up for MTD, the only way for you now to submit your VAT return is sort of manually through the government gateway account. And then from April 2022, all VAT returns are going to need to be submitted through compatible software using MTD. If you want any more information on the MTD updates, the VAT notice is 700/22, and it's now all up to date. And that's everything from me. I go rattle through that quite quickly, just so I know we're sort of running out of time. There was one question, Meera.
Okay.
Which was, should we still be recording services purchased from EU suppliers using the reverse charge on our VAT returns?
Yes, the reverse charge mechanism, I think a lot of people have got confused with it. It doesn't just apply for the EU. Any services you receive from outside the UK, whether that is whether that's from the EU or non-EU countries, yes, you do have to use that reverse charge mechanism.
Yeah, it's probably a question we get quite a lot, where people really thought it was an EU ruling, whereas actually it does apply to all.
It applies to all countries, anyone who is non-EU outside the UK. And I think it was highly talked about when we were within the EU. Maybe that's why people got confused. But this services applies to everybody. Even prior to Brexit, you have to have recorded services received from non-EU countries. So now we are not part of the EU, so there won't be any changes into that. The EU still have to record the reverse charge. If there's the more questions, we will get back to you guys by email, and we will get in touch with you. By all means, please do get in touch with us for any further details you require from any of the topics we have discussed today. Thank you all for joining us, and thank you very much for your time. Bye.
Thank you. Bye.